Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Enraja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. A very important video. Many times I get this question. What is the difference between debt equity ratio and TOL by TNW? They both look like same. They are used interchangeably, but bank to bank there are some differences. In your academics, when you have studied your finance programs, you would have studied debt equity ratio is something where debt is only long-term debt and equity represents owner's money. So in debt equity ratio, what basically you compare is, you will be comparing the long-term debt with equity so that you will be able to measure the long-term solvency of the business. You can measure the financial risk associated with that business. Okay. So the focus is more on comparing the long-term debt with equity. Whereas TOL by TNW ratio is even more comprehensive, because when we say TOL, it stands for total outside liabilities. It stands for total outside liabilities. It means all the outside liabilities, whether it is current, that is repayable within 1 year, or whether it is long term, that is repayable even after 1 year. All the liabilities will be included. That's why it is called as total outside liabilities, and that will be compared with the tangible net worth of the business. So it is not mere equity, because when we say equity, it is basically sum of equity share capital plus reserves and surplus minus accumulated losses. That's what equity basically means. But here when we say tangible net worth, what we are doing is we are considering share capital. Okay, we are considering share capital. With that, reserves and surplus are added and accumulated losses are subtracted. Of course, it will be obviously adjusted in this. And in addition to that, if there are any revaluation reserves, they are deducted. That is, if revaluation reserves are included in reserves and surplus, they are deducted. And intangible assets of the company will also be deducted. Okay. So here you are comparing the total outside liabilities with the tangible net worth, and with that you are going to come to conclusion about the long-term solvency of the business. You are going to come to conclusion about the financial risk associated with that business. Okay. But in what context they differ? See, when we say debt equity, look at here. The focus is only the long-term debt, but here in TOL we are considering all the liabilities. In debt equity, under debt we are considering only long-term debt. And I started with the rider saying that this is what you would have studied in your finance programs. Okay, whether you have studied in your chartered accountancy or BCom or any finance program, this is what you see. But in reality, let's say you are in bank, you will see debt equity ratio used in different context. That is, they'll be using debt equity ratio for term loan purposes. In many banks, when they say debt equity, that is only for term loans. TOL by TNW for evaluating the business as a whole. So how that works? In case of a term loan, there is going to be a cost of the project and there is going to be means of finance, right? Cost of the project and means of finance. The cost of project can be the cost of assets that got to be acquired with the support of the term loan. Okay, let's say land, building, let's say it's for putting up some factory. So land, building, plant and machinery, all put together makes your cost. Now for funding this cost, how much owners are going to bring in? What is the percentage they are bringing? Let's say owners are going to bring in 25% of this cost as their margin. Okay, then that margin what they are bringing in for meeting this cost of project will be considered as equity. So this is another dimension of debt equity, but this is something very specific to banks for their term loan purposes. So if they are bringing in 25%, then obviously the remaining 75% they'll be approaching for a loan, right? So 25% from their pocket means remaining 75%, obviously let's say the term loan. So here, by looking at this cost of project means of finance, what we can make out is this project 25% been funded by owners, we call it as equity, remaining 75% is coming in the form of a loan. Now the debt here is 75%. For understanding purpose, let's say cost of project is 100, so term loan is 75 and margin is 25. Okay, so what is the debt element here? Debt element is this 75. What is the margin they bring in the form of equity? That is 25. Okay, so equity is 25. And for this project, what is the debt equity ratio? Sanctioning authorities will be interested in knowing in that. What is the debt equity for the project? For the project, debt is 75, equity is 25. So the ratio is 3:1. It means for every 3 rupees loan availed by the company or the business for this project, 1 rupee is coming from owners. So let me summarize this for you. We were discussing about debt equity, TOL by TNW. In debt equity ratio, the focus is long-term debt, that is compared with the equity. In TOL by TNW, the focus is entire outside liabilities, that is compared not just equity but the tangible net worth. So this is more comprehensive ratio to evaluate the overall long-term solvency of the business, whereas this is focused only on comparing the long-term debt with the equity. But banks also go for an extended interpretation of this debt equity ratio, but that is not for the business as a whole, but that is with reference to projects. That is with reference to project. It means they take cost of project, they take means of finance, they see how much of the cost of project is coming through debt, how much owners are contributing in the form of margin, that is called as equity, and that is compared. So that debt equity ratio is only with reference to term loan for that project purposes. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.